The vessels sit loaded and ready, their cargo holds brimming with fuel. But there's nowhere for them to go. China, the destination that once seemed guaranteed, has gone dark. Throughout June of this year, something unprecedented occurred in global energy markets. The flow of American energy products to China didn't just slow down, it stopped completely. No crude oil made the journey across the Pacific. Natural gas shipments ceased. Coal deliveries ended. According to Bloomberg's analysis, an entire trade corridor worth billions of dollars every month simply went silent. For energy companies across the United States, this represents far more than a temporary disruption in business. This is the scenario that keeps executives awake at night, watching the world's most voracious energy consumer slam the door shut without warning. But here's what makes this situation truly alarming. Beijing isn't panicking or scrambling to find alternatives. The infrastructure to replace American supplies was already being built. Russia, Iran, and domestic Chinese pipelines are now filling the void. Even when diplomatic channels appeared to open, the damage proved irreversible. Reuters' coverage from May of this year documented how trade negotiators in Washington and Beijing announced a partial de-escalation of certain tariff measures. It was supposed to be a reset, a chance to restore commercial relationships. Yet Chinese energy buyers didn't budge. Not a single purchase order was placed for American fuel. The explanation wasn't simply about pricing, though that mattered. According to interviews the Financial Times conducted with Chinese refinery operators and power utility managers, the core issue was trust. They expressed fundamental doubts about whether American energy supplies could be counted on if geopolitical relations deteriorated again. In their assessment, dependability had become more valuable than competitive pricing. The unraveling started with liquefied natural gas, one of America's most strategic export products. During the opening 3 months of this year, Chinese purchases of U.S. LNG plummeted by more than 70% compared to the same period the previous year. Customs data compiled by Bloomberg showed that by March, the flow had stopped entirely. Analysts at Capiler, a leading commodity tracking firm whose assessments were quoted by Reuters, pointed out that this marked the most extended interruption in LNG shipments from America to China since the trade conflicts of 2019. The catalyst was a dramatic tariff escalation. In February, Beijing raised import duties on American LNG cargoes from 15% to 49%. Overnight, the economics became impossible. American gas couldn't compete at that price point. What makes this shutdown particularly significant is that it occurred despite existing contractual obligations. Major Chinese energy corporations, Sinopec and PetroChina among them, had signed substantial long-term agreements with U.S. gas producers during 2021 and 2022. These weren't short-term deals. They were designed to secure American gas supplies all the way through the 2040s. Yet those contracted volumes aren't moving. Reporting by the Financial Times in April revealed that force majeure declarations and postponed cargo schedules have left American export terminals along the Gulf Coast operating far below capacity. The infrastructure represents investments measured in billions of dollars, and the expected returns on those investments are now deeply uncertain. The crude oil picture tells an equally troubling story. Rewind to June of last year, and China was importing approximately 166,000 barrels of American crude every single day. Fast forward to March of this year, and that figure had dropped to zero. Reuters identified two primary drivers behind this collapse. First, Chinese tariffs ranging from 10 to 15% made American oil less competitive. Second, and perhaps more importantly, Russian crude began flooding Asian markets at unprecedented discounts. Moscow was offering price cuts of $10 per barrel compared to Brent benchmark pricing. Chinese refineries found themselves in an ideal position. They had political justification to avoid American supplies, and they had powerful financial incentives to buy Russian oil instead. The decision was straightforward: coal has followed the same trajectory. Last June, Chinese buyers purchased $90 million worth of American coal. By the middle of this year, monthly sales had collapsed to occasional single shipments that barely register in trade statistics. A comprehensive Reuters analysis of commodity movements across Asia showed that during May, only one American coal cargo actually unloaded at a Chinese port. Just one. For the world's largest coal consumer to effectively stop sourcing from the United States represents a fundamental restructuring of global energy trade patterns. Then there's ethane, a specialized petrochemical feedstock that had been one of the few remaining bright spots in the energy trade relationship. As recently as last year, American ethane exports to China exceeded 500,000 barrels per day. This material feeds coastal cracking facilities that convert ethane into plastics and other petroleum-based products. But in May, the U.S. Commerce Department implemented a new licensing requirement. From that point forward, exporters would need to obtain permits before shipping ethane abroad. Reuters documented how this new regulation immediately paralyzed shipments. Contracts covering 284,000 barrels per day that were scheduled for June delivery never left American ports. Industry executives speaking to the Wall Street Journal expressed concerns that the licensing process would inject politics into every transaction, making China's position as a reliable buyer even more precarious than it already was. This creates serious complications for Chinese industry. Without American ethane supplies, the coastal cracking plants face significantly higher costs when sourcing from Middle Eastern suppliers. Bloomberg quoted company executives warning that switching suppliers could result in losses approaching $700 per ton of output. Yet Beijing appears prepared to accept these short-term financial hits in exchange for long-term supply security. The strategic calculation is clear. Temporary disruption and higher costs are preferable to remaining dependent on a supplier that might cut you off for political reasons. Simultaneously, China has been systematically deepening its energy relationship with Russia and Central Asian nations. Bloomberg's analysis from late last year noted that pipeline gas accounted for 41% of China's total natural gas imports, and that percentage continues rising as LNG purchases level off. Domestic Chinese gas production is expanding as well. Figures from China's National Bureau of Statistics show that domestic gas output increased by 5.6% in 2023, reaching 232 billion cubic meters. When you combine growing pipeline imports with increasing domestic production, Beijing's need for seaborne American LNG diminishes substantially. The consequences are rippling across global energy markets. Reuters reported in August that American crude exports had fallen to 3.1 million barrels per day, the lowest level since 2021, as buyers in both Asia and Europe reduced their orders. Shipments specifically to Asian markets dropped to 862,000 barrels per day, the weakest performance since 2019. With China absent from the market for 5 consecutive months, the Gulf Coast is experiencing logistical bottlenecks. American oil is being redirected to other buyers, but only by offering significant discounts that eat into profit margins. The International Monetary Fund addressed these developments in its July commodity market outlook, warning that structural shifts away from American energy sources pose serious long-term risks to U.S. producers. The investments in LNG terminals, pipeline networks, and export facilities were all predicated on assumptions of steady Chinese demand extending through 2040. If Beijing's pivot toward Russian pipelines and domestic production becomes permanent, those assets could end up stranded. Expensive infrastructure that never achieves its projected utilization rates. From Beijing's perspective, this strategy aligns with broader environmental objectives. A study referenced by Reuters in August found that China's carbon emissions declined by 1% during the first half of this year, driven primarily by a 3% reduction in power sector carbon intensity. Expanded renewable energy generation combined with efficiency improvements have reduced coal consumption at the margins. Reducing imports of fossil fuels serves dual purposes. It diminishes exposure to American political leverage while simultaneously advancing climate commitments. However, the energy transition remains uneven and incomplete. The Wall Street Journal highlighted in June that China's petrochemical sector continues to depend heavily on imported feedstocks. Ethane, naphtha, and liquefied petroleum gas are essential raw materials for plastics manufacturing and industrial materials production. If American supplies become politically inaccessible, China must navigate between Middle Eastern producers and developing domestic substitutes. This dependency could emerge as a significant vulnerability if geopolitical tensions continue escalating. Meanwhile, American clean energy developers are confronting their own contradictions. The Financial Times reported in July that tariffs imposed on Chinese solar panels and wind turbine components have driven up costs for renewable energy projects across the United States. As a result, America's decarbonization timeline is facing delays precisely as fossil fuel exports to China evaporate. The decoupling thus creates problems on both sides. U.S. energy exporters are losing crucial markets while U.S. renewable energy developers are paying higher prices for essential components. These disruptions extend beyond energy into agriculture as well. The U.S. Department of Agriculture noted in May that soybean and corn exports to China were already declining due to retaliatory tariffs. Now, energy joins agriculture as a major sector that has been decoupled from its largest overseas customer. The assumption that Chinese demand represented a permanent feature of American export markets has been proven wrong twice within less than a decade. The political ramifications in Washington are immediate and intense. Elected officials from energy-producing states are warning about job losses and budgetary pressures. Reuters quoted Texas state officials in July expressing concerns that LNG terminal projects representing billions in investment capital may never operate at full capacity. Policymakers are being forced to confront an uncomfortable reality. Global energy demand patterns are evolving in ways that undermine the fundamental business case for these projects. Yet financial markets have remained surprisingly stable. Goldman Sachs analysts told Bloomberg in February that Chinese tariffs would have limited impact on global energy prices. Oil benchmark prices have barely moved. LNG pricing has remained within anticipated ranges. If prices are holding steady, does that indicate U.S. losses are being absorbed by other buyers, or does it suggest markets are underestimating the scale of structural change currently underway? India provides a partial answer to that question. Reuters noted in June that Indian imports of American crude oil increased from 175,000 to 253,000 barrels per day over just 3 months, while coal imports rose by 12%. This suggests some volumes are finding alternative buyers, but the scale matters enormously. India's absorption capacity cannot match China's. Diversification softens the impact, but it doesn't eliminate it. Europe faces its own constraints. The European Union has climate commitments that make long-term fossil fuel contracts politically difficult. While imports of American LNG into Europe remain substantial, they're limited by both infrastructure capacity and policy commitments to reduce carbon emissions. The gap created by China's absence cannot be easily filled by European buyers. These disruptions extend beyond energy into agriculture as well. The U.S. Department of Agriculture noted in May that soybean and corn exports to China were already declining due to retaliatory tariffs. Now, energy joins agriculture as a major sector that has been decoupled from its largest overseas customer. The assumption that Chinese demand represented a permanent feature of American export markets has been proven wrong twice within less than a decade. The political ramifications in Washington are immediate and intense. Elected officials from energy-producing states are warning about job losses and budgetary pressures. Reuters quoted Texas state officials in July expressing concerns that LNG terminal projects representing billions in investment capital may never operate at full capacity. Policymakers are being forced to confront an uncomfortable reality. Global energy demand patterns are evolving in ways that undermine the fundamental business case for these projects. Yet financial markets have remained surprisingly stable. Goldman Sachs analysts told Bloomberg in February that Chinese tariffs would have limited impact on global energy prices. Oil benchmark prices have barely moved. LNG pricing has remained within anticipated ranges. If prices are holding steady, does that indicate U.S. losses are being absorbed by other buyers? Or does it suggest markets are underestimating the scale of structural change currently underway? India provides a partial answer to that question. Reuters noted in June that Indian imports of American crude oil increased from 175,000 to 253,000 barrels per day over just 3 months, while coal imports rose by 12%. This suggests some volumes are finding alternative buyers. But the scale matters enormously. India's absorption capacity cannot match China's. Diversification softens the impact, but it doesn't eliminate it. Europe faces its own constraints. The European Union has climate commitments that make long-term fossil fuel contracts politically difficult. While imports of American LNG into Europe remain substantial, they're limited by both infrastructure capacity and policy commitments to reduce carbon emissions. The gap created by China's absence cannot be easily filled by European buyers. The longer this situation persists, the more permanent it appears to become. The Financial Times observed in April that Chinese energy companies have relocated procurement operations to Moscow and Tehran. Institutional knowledge is being rewritten. When contracts are renegotiated, shipping routes are redesigned, and trading desks are reorganized, returning to previous arrangements isn't simply a matter of political will. It requires rebuilding complex operational relationships. The zero figures are stark and unambiguous. 0 American LNG arrivals in China during March. 0 crude oil imports in June. 0 coal by mid-year. Each data point individually might be dismissed as temporary. Taken together, they describe something more fundamental, a structural decoupling of energy trade relationships. Once supply chains are severed and redirected, rebuilding trust becomes far more difficult than repairing pipelines or redirecting tankers. The underlying question now extends beyond trade balances and monthly export figures. If China no longer requires American energy supplies, what leverage does Washington actually retain in bilateral negotiations? And if American infrastructure was constructed based on assumptions of permanent Chinese demand, how much of that investment represents sunk costs that will never generate expected returns? A tanker sitting idle in international waters might appear to represent a temporary pause in commerce. But if that vessel never unloads its cargo, if the contracts that once guaranteed delivery are no longer being honored, that pause transforms into something more significant. It becomes a symbol, not merely of collapsed trade flows, but of a fundamental reordering of global energy relationships. And so the ultimate question lingers. Was June 2025 simply the month when American energy exports to China temporarily stopped? Or was it the moment when the world discovered that China could choose never to restart them, and that Beijing had already built the infrastructure to make that choice permanent?